Welcome to the Opening Bell Report.
I have to tell you, I spent about 20 minutes this morning just staring at my screen.
Oh, yeah.
I honestly thought my calculator app was broken. Or maybe I just, forgotten how to do basic math.
It's one of those mornings.
It was. I actually reran the numbers 3 times just to be sure I wasn't losing my mind.
Usually when the math looks that broken, it means the market is trying to tell us something.
Or hiding something. It feels like it's hiding a winning lottery ticket in plain sight.
Okay.
Because the numbers we're looking at for this deep dive, they just don't add up. It's like looking at an equation where 2 plus 2 equals a banana.
It's a very specific image, but I think I know where you're going with this. The market seems to be living in a completely different reality than the balance sheet.
Completely different. Okay, let's set the stage for everyone. Picture this. You have a company. The entire entity, every desk, every patent, every server, is valued by the market at roughly $27 billion.
Okay. A $27 billion market cap. It's respectable, but nothing too crazy in tech.
Right. But then you dig into the filings, which we did, and you find that this same company has just one contract. A single deal.
With a single client.
A single client that is practically guaranteed to bring in over $17 billion.
Which is, what, more than half of the company's total value?
Yeah.
Locked in from one handshake, essentially.
Exactly. It's like walking into a car dealership. You see a car with a sticker price of 27 grand. You open the glove box, and there's $17,000 in cash just sitting there.
And the dealer's just looking at his phone.
Just standing there, completely ignoring it. It feels like Wall Street has collective amnesia.
And that is exactly the tension we're unpacking today. The company is NBIS Group, ticker symbol NBIS.
Right.
And the analysis report we're diving into, it makes a pretty compelling case that this disconnect is not going to last.
The analysis calls them a potential core weave killer.
Which is a massive title.
A huge title to throw around in the AI space. For anyone who doesn't know, CoreWeave is like the private equity darling of AI cloud computing. So calling NBIS a killer is a big statement.
It is. It implies they're moving from a niche player to, a dominant force.
So our mission for this deep dive is to figure out why the market is sleeping on this. Is there a catch we're missing? Or is the market just slow? We're breaking down a specialized analysis. It's simply titled NBIS and Microsoft. The $17 billion deal Wall Street is ignoring.
Puts it pretty bluntly.
It really does. And the date here matters. This report is from January 18th, 2026. The AI trade has been so volatile, people are nervous. They're wondering if the bubble's bursting or just taking a breath. And in all that noise, NBIS has just reclaimed a pretty big psychological level, $100 a share.
And that context is crucial. Because in a volatile market, investors often flee to safety. They stop looking for growth at all costs and start looking for, guaranteed cash flow.
Which brings us to the Microsoft deal.
Exactly. That's the headline.
So let's get right into the alpha, as the report calls it. The big catalyst. We aren't talking about a rumor here, right? This isn't sources say or some vague press release.
No, this is ink on paper. Definitive. Late in 2025, NBIS signed a massive agreement with Microsoft.
Okay.
And we need to be really specific here because the details matter a lot. This isn't software. It's not consulting. It is a leasing agreement for GPU capacity.
So they're renting out the shovels for the gold rush.
That's the classic analogy, but let's sharpen it a bit. They are providing the raw computing power, the actual infrastructure that Microsoft needs to run its AI models.
And the numbers are just...
They're staggering.
Yeah.
The absolute minimum value of this deal is $17.4 billion.
$17.4 billion. That's a lot of shovels.
And with extensions, it could push up to $19.4 billion. This is a 5-year agreement.
Wow.
And the analysis makes a point to say the infrastructure for this is being built right now. It's tangible. It's at the NBIS data center in Vineland, New Jersey.
See, that's the part that gets me. This isn't just theoretical code in the cloud. It's physical hardware in New Jersey.
Right.
But here's the thing. If the deal is so huge, why does the report say Wall Street is ignoring it? How do you hide a $17 billion elephant in the room?
Well, that's where market psychology comes in. It's fascinating, really. The analysis points out that this deal was originally priced in back in September 2025.
Okay, so when the news first broke...
Right, the stock reacted.
Yeah.
It popped. But then NBIS entered what traders call a consolidation period.
Quiet zone.
The boring zone, yeah.
Yeah.
The stock price just went sideways or drifted down. And you know how it is in AI trading. If you aren't making headlines every single day, investors get bored.
They have the attention span of a goldfish.
Exactly. They chase the next shiny object, the next IPO. And the report suggests that during this quiet period, the market effectively forgot about the sheer magnitude of what was signed.
They forgot about $17 billion. It sounds absurd when you say it out loud.
It does, but the analysis argues that this amnesia is real. The deal didn't go away. The revenue didn't disappear. But the hype cycle moved on.
And that's where the opportunity is supposed to be.
That's the argument.
It's incredible how inefficient the market can be when it's distracted. But I want to push back on this a bit. The quality of the revenue, you said it's a leasing deal. Why does the analysis flag that as so important?
It all comes down to the security of that revenue. The report describes this as a take-or-pay style leasing contract.
Take or pay. Okay, break that down for us.
It means exactly what it sounds like. Microsoft is on the hook to pay for this capacity, whether they use it every second of the day or not.
Ah.
If they use the servers to train a new AI model, they pay.
Oh.
If they let the servers sit idle because their code isn't ready, they still pay.
So it's guaranteed rent. It's like signing a lease on an apartment. The landlord doesn't care if you're there or on vacation for a month. They just want the check.
Precisely. Microsoft is effectively paying NBIS to build this infrastructure for them. It creates a revenue floor that is incredibly rare in the tech world.
Right. Usually you just have projections. We hope to sell this many.
Exactly. We hope people buy our new phone. Those can miss. Here, you have a legally binding contract that says you will pay us this amount.
That just changes the risk profile completely. It's not speculative.
It's not. And that brings us right back to that disconnect we started with. Let's do the math the report lays out, because this is the part that makes your head spin a little.
Yeah, let's walk through this valuation. Because if the deal is real, the stock price should reflect it. So why is my calculator telling me it's cheap?
In theory, the market is efficient. In reality, not always. So as of this analysis on January 18, 2026, NBIS has a market cap of about $27.4 billion.
Okay, $27.4 billion, price tag for the whole company.
And they have a guaranteed backlog of over $17 billion from just one client.
Microsoft, so if you just, doing back of the napkin math, 27 minus 17 is 10. The market is valuing the entire rest of NBIS.
All their other clients, their intellectual property, everything else.
At roughly $10 billion.
Less, actually, when you factor in cash and other assets. The analysis is basically saying the market is severely undervaluing the rest of the business.
It's like buying a shopping mall and only paying for the Macy's lease, and you get the rest of the stores for free.
That's a great analogy.
Yeah.
And it's not just about the backlog. The analysis highlights the management guidance for the future.
Right.
And this is where we move from the safe floor to the growth ceiling.
Because if a floor is nice, but investors want growth, what are they projecting?
The report notes that management is projecting an annualized revenue run rate of $7 to $9 billion by the end of calendar year 2026.
Wait, 7 to 9 billion per year?
That's the run rate, yes.
Hold on, let's pause on run rate, just to be clear. That doesn't mean they'll make 9 billion in 2026, right?
No, good catch. Run rate means that by the end of the year, they'll be generating revenue at a pace that, if you annualized it, would equal 7 to 9 billion.
It's a measure of velocity.
Exactly. How fast the engine is spinning at that moment, and it's speeding up significantly.
Okay, got it.
So the analyst in the report does a hypothetical valuation here. Let's take the upper end of that guidance, $9 billion in revenue run rate.
Okay, let's play with the big number.
In high-growth AI infrastructure, a 10x revenue multiple is pretty standard, sometimes even conservative, depending on the market.
Sure, 10x is common for a company growing this fast.
So keep it at a simple 10x. You take $9 billion in revenue, and you apply that 10x multiple.
You get a $90 billion market cap.
$90 billion. Now, compare that to the current market cap.
$27 billion. That's more than triple, a 3x.
It's a potential 3x bagger, as traders say. The analysis argues it's hiding in plain sight because people are looking at trailing numbers, what they did last year, instead of the forward guidance.
Which is backed by that massive Microsoft contract.
Exactly.
That is the aha moment.
Yeah.
You have a floor preventing you from falling and a feeling that's potentially 3 times higher. It really does highlight the inefficiency. But, playing devil's advocate, why wouldn't the market price this in? Execution risk.
That's always a risk.
Yeah.
Can you actually plug in all the servers? But the deal structure suggests Microsoft did their due diligence. They don't sign a $17 billion check unless they're pretty sure you can deliver.
True. They have armies of engineers for that stuff. So if the fundamental value is there, let's shift to timing. Because you can be right about a stock, but be early, and you still lose money. Why now?
Right. It's the wake-up call. The analysis focuses heavily on the technicals, the study of the price action itself.
The chart.
Yeah. Because fundamentals tell you what to buy, but the technicals can tell you when.
And the stock had cooled off a lot, right?
Significantly. It had hit highs of, $141 previously, but then it just drifted all the way down to test the $100 level.
And $100 is a huge psychological number.
Huge. Humans love round numbers. Traders definitely love round numbers. If a stock breaks below 100, it can get ugly. But if it bounces off it, that confirms support. It tells the market, okay, buyers are stepping in here. This is the floor.
And the report says that's exactly what happened.
Yes. On January 17th and 18th, the stock made a decisive move. It moved up 4.66% to close at $108.73.
Now, to some listeners, 4% might not sound like a lot.
But for a company this size, bouncing off a key support level like that, it's significant. And specifically, the analysis points to a chart pattern called a bullish engulfing candle.
Okay, bullish engulfing. Sounds aggressive. Like a shark eating a smaller fish.
That's actually a pretty good visual for it.
Yeah.
Technically, it means the green candle for the day, the buying pressure, completely engulfs the price range of the previous day's red candle.
So the buyers just wiped out the sellers from the day before.
Completely. It signals a sentiment flip. The report interprets this as the sign that the consolidation phase, that boring phase, is officially over.
The bleeding is stopped. The chart is waking up.
And they're not just looking at the chart in isolation. They compare it to the consensus price targets from other Wall Street analysts. The average target is $164.20.
Which is, what, about 51% upside from that 108 price point?
Right. So you have the fundamental valuation saying it should be worth more, the analyst saying it should be worth more, and now the chart signaling a reversal.
It's layering the evidence, but there's one more layer here the report highlights. The volatile one. The one that gets the Reddit threads excited.
The squeeze.
The short squeeze, I saw that. Short interest is around 17%.
Approximately 17%. Means a pretty significant chunk of investors are actively betting against NBIS.
Which just seems incredibly risky given what we just discussed. Why would you bet against a company with a $17 billion guaranteed paycheck?
Well, maybe they think the AI bubble is popping overall. Or maybe they're just hedging. But the analysis argues that 17% is a dangerously high level of short interest if positive news hits.
Explain the mechanism for us. How does that trap snap shut?
So short sellers borrow stock to sell it, hoping to buy it back cheaper. But if the price starts going up, like with this bullish signal, they start losing money.
And their losses can be infinite, theoretically.
Exactly. The pain gets too great. They have to cover their position, which means buying the stock back at the market price to stop the bleeding.
But by buying, they drive the price up even further.
Which forces more shorts to panic and buy. It's a feedback loop, a cascade. The analysis identifies $115 as a key level.
To trigger.
If it breaks above 115, they argue it could trigger this cascade.
Rocket fuel.
That's the idea. The report suggests this short covering could send the stock right back toward its all-time highs of $141 and beyond.
So, to recap the thesis, you have the fundamentals, the $17 billion safety net. You have the technicals, the bounce off $100. And you have the market mechanics, the short squeeze, as a potential accelerant.
That's how the analysis frames it, a triple threat. The downside is limited because Microsoft has to pay them, but the upside could be explosive.
It's fascinating because it frames the current price not just as a dip, but as an actual mistake by the market.
And that's what active investors are always hunting for, right? An inefficiency,
a
mispricing. The biggest opportunities come when the market is demonstrably wrong.
So what does this all mean for the average person looking at this? The analysis mentions something about smart money versus retail investors.
It's a tale as old as the market. Institutional investors, the smart money, they often do their buying during those boring consolidation periods. They accumulate when the headlines are quiet.
They're the ones buying from the bored investors who gave up at $100.
Exactly. By the time the stock hits the front page again, soaring past 150, the smart money has already built their position.
And the retail investor usually comes in at the top when the hype is loudest.
Correct. The report is essentially shouting, don't wait for the hype, look at the contract. They're arguing that based on the fundamentals, the price should be closer to 200, yet here it is at 108.
The window is open now, is what they're saying.
That's the argument.
The analysis also throws out a comparison we have to touch on. They ask, is this the next NVIDIA?
That's the holy grail of comparisons in AI. Everyone wants to find the next NVIDIA.
That's a bold claim. Is it fair? NVIDIA is a $1 trillion monster.
It is extremely bold. And we should be clear, they're not the same business model. NVIDIA designs the chips, they're the architect. NBIS is more like the builder and the landlord.
Right. NVIDIA sells the pickaxes. NBIS owns the mine where the digging happens.
Good distinction. But the point the analysis is making isn't about the business model. It's about the trajectory of demand. The demand for compute isn't going away.
It's only growing.
And unlike so many other AI plays that are just speculative ideas with zero revenue, NBIS has that safety net.
The Microsoft contract.
That's the key. That revenue floor from Microsoft distinguishes them from the pack. It reduces the risk profile so much.
It's hard to go bankrupt when Microsoft owes you $19 billion.
It certainly helps you sleep at night.
It really challenges the idea that the easy money in AI has already been made. The report is very much in the buy the dip camp.
Extremely. The tone is bullish, it's contrarian.
Yeah.
They're betting the market is wrong, the shorts are wrong, and the spreadsheet is right.
Which brings us to a final thought. We've unpacked the deal, the valuation, the squeeze potential, but there's a provocative question lingering here for me.
What stands out to you?
Well, the analysis is asking if Wall Street is wrong again, and history shows they often are. But I keep thinking, if a $17 billion floor wasn't enough to wake the market up back in September, what makes us so sure it'll wake up now?
That is the billion-dollar question. Catalysts are tricky. Sometimes good news doesn't matter until it matters. Sometimes it takes a specific chart breakout, like the one we're seeing now, to force people to look again.
And the real question for you, the listener, is, by the time the market finally does wake up, by the time the short squeeze happens and the headlines are flashing, will the opportunity to buy the dip already be gone?
That's the risk. The market is efficient eventually, but rarely immediately. The window to act on a mispricing usually closes the moment the crowd realizes it's there.
Exactly. Something to mull over next time you see a stock trading sideways and you feel bored. Sometimes boring is where the money is hiding. Thanks for diving in with us today.
Always a pleasure.
Don't forget to like, share, and subscribe for more.